This is a video on the infrequent occurrence of sustained abnormal project returns. This topic was briefly discussed in the PE multiple video in the valuation calculation playlist on the Polaris Investing YouTube channel. That video discusses mean reversion, capped growth, and uncapped growth. This video focuses on uncapped growth, referring to it as sustained abnormality. This video is brought to you by PolarisInvesting.com, site for creating defensible valuations. As a reminder, business valuation is based on expectations derived from skillful consideration of past facts and future possibilities. Let's take a quick look at the PolarisInvesting.com website, particularly the ticker page. Here we're looking at it as an example, Microsoft. As a reminder, up here in the right-hand corner is where you enter the sales growth forecast, and you can move the slider around, and you'll see here that the theoretical and the practical valuations change as you move the slider around. You can return back to the default value calculated by Polaris. You can also choose other values, namely the industry standard or industry average sales growth forecasted, and also the forecasted sales growth for the S&P 500 stocks. At the bottom of the ticker page is additional information, including other input values used in the valuation formula. Specific values are profit margin and future price earnings multiple. Other input values to the valuation formula can be indirectly entered through the sales growth slider, and that's discussed more in the valuation calculation playlist videos. Since originally recording this video, two other input sliders have been added for future profit margin and future price earnings multiple. These values used to have to be entered indirectly through the sales growth slider, but now can be entered directly through their own sliders. Turning back to the welcome screen for this presentation, point out that it reflects that the vast majority of the time when using the Polaris Investing website, you use the values provided by Polaris, particularly those input values at the bottom of the ticker page. One of those values is the future price earning multiple, and it assumes that the rate of return that a company earns on its projects mean reverts to the cost of equity in the period beyond the near term, or what's referred to as the terminal value or continuing value period. The cost of equity is the expected risk-adjusted rate of return on future cash flows. Thus, is referred to cost of equity is referred to as the mean, and we call and therefore the phrase mean reversion. Now, in rare situations, it may be reasonable to assume that the return a company earns on its future projects reverts, but to a value different than the cost of equity. This is referred to as sustained abnormality, and depicted in the picture as this being different than what is typically done using the website. I want to stress that sustained abnormality only applies to a very few companies. But when it does occur, it's often extreme. A typical sustained return on projects is around 10%, but some companies can sustain 20% or even higher returns. What enables these rare companies to sustain high project returns is their durable competitive advantage, also known as moat. Their moat not only deters mean reversion, it prevents it. Well, extreme abnormality is observed in many areas. So let's take, for example, income distribution in the United States. The data shown here is for 2015. In the top bar chart, you see quite a range of incomes. Where the average income was $75,000 a year, but the median was much lower than that, only $55,000 a year. And the reason is that the high income earners distort the average, and the median, representing half above that amount and half below that amount, is more representative of what the typical income is, or that was reported. Now, what's interesting about the distribution of incomes is as the incomes get larger and larger, fewer and fewer people are reporting that number. And then in this chart, it shows a fairly high percent at the very high end, but it's just because it just stops and lumps everybody making $250,000 or more all together. But it does, if it were to continue to break out salaries in small bands, it would continue to go down, down, and down. But what's interesting is it goes down, these incomes continue to go ever higher and higher. You see that here at the bottom of this graph. The very top 1% all the way up to the top 0.01%, you see enormous jumps in income. Starts off at $350,000 to be in the top 1%. Then as you go up to the top 0.1%, you get into the millions. And then as you go to the very top, 0.01%, you're in the $30 million range. So as you can see, annual income varies considerably at the extremes. Another reference to this widening gap between income is shown here. It also shows how net worth changes as well, from $4.5 million for 1%ers all the way to $100 billion for the ultra wealthy billionaires. Now, to understand the impact of extreme abnormal returns on valuations, it is important to understand how the PE fits into a valuation, because that's where extreme sustained returns on future projects are factored in. So let's first review the valuation formula used by the Polaris Investing website. Formula is shown here, and it is discussed in detail in other videos, particularly in the valuation calculation playlist. But as you recall, it's broken up into two distinct terms. The first term is just simply the dividend times 5, which is the number of years that Polaris uses. And that represents the near-term cash flows, and suggest you go out and watch a video blog on accuracy, useful accuracy, to understand why Polaris uses that term for the representing the near-term cash flows. The second term here represents the terminal value, or also called the continuing value. As a reminder, this second term here is where most of the valuation is derived from. Up to 80 to 90% of the total valuation comes from the terminal value portion. Here in the terminal value portion, there are three dominant inputs. Namely, the growth of sales, and that's why on the Polaris Investing website, the growth slider is provided, but also the future profit margin and the future price earnings multiple weigh heavily into the terminal value calculation. Now, the other input values, future shares and cost of equity, factor in, but not nearly to the extent that these three inputs of sales growth, future profit margin, and future PE do. As I mentioned earlier, growth of sales directly, you can do a direct input of that off the Polaris Investing website through the sales growth slider, but these other two dominant terms, you enter any changes over to the Polaris provided values are done indirectly through the sales growth slider. Since originally recording this video, two other input sliders have been added for future profit margin and future price earnings multiple. These values used to have to be entered indirectly through the sales growth slider, but now can be entered directly through their own sliders. Now, the simplified formula that Polaris uses does have trade-offs. And one of the trade-offs is a little bit loss of accuracy, but the benefit is having very few input values that need to be inserted. In fact, Polaris, with it calculating the profit margin and price earning multiple that are usually appropriate, the only input value that a user needs to enter on the Polaris side is growth of sales. But anyway, these trade-offs have generated some criticism, and one of the criticism is here from Curtis Jensen. He was the chief investment officer for Third Avenue Management. He said that discounted cash flow is like looking through the Hubble telescope. You move it a bit, and you end up looking at an entirely different galaxy. Now, this comment is a little too critical, because the whole purpose of discounted cash flow, and particularly the formula used by Polaris, is to simplify the valuation formula to the point that there are just a few input parameters required. The more input values needed in a formula, the more chance that there's inaccuracies in those inputs. So ideally, you get a balance between enough inputs to create an accurate result, but not so many inputs that you just get lost in all the noise. So I don't think this criticism is really warranted. But what it does mean is that the few inputs that are used need to be thought through carefully, because, as Curtis Jensen's pointed out, slight changes in these three dominant inputs can have a significant impact on the overall valuation. Now we have an understanding of how the price earnings multiple fits into the valuation formula used by Polaris. Let's move now to the significance of assuming that a rate of return on projects mean reverts to cost of equity. In the late 1960s, which is going to be almost 50 years ago, a professor from finance professor from Princeton named Burton Malkiel first proposed the idea of breaking cash flows up in the near term, and then after the near term, the idea of a terminal value, and like I've said before, is also known as a continuing value. Well, that terminal value, he proposed, be calculated using the geometric progression, which is shown here, that can calculate a price. So if you're assuming current price, then you're using the earnings per share currently, or typically the trailing 12-month. You grow it to the end of the current year. You take it times 1 minus a reinvestment rate, where percent sign means reinvestment rate. That gives you the distribution rate. So this whole factor here represents the end of the year distribution. And then you assume some growth of earnings, and then discount it all back at the cost of equity, and then you end up with some price. Now, for those who are interested in the exact derivation of this formula, I suggest you watch the multi-stage video in the concepts playlist out there on the YouTube channel, the PolarisInvesting.com YouTube channel. Now, if you divide this equation by earnings per share on both sides of the equation, you get an expression for the price earnings multiple, which is in this portion of the formula. So if I move forward and talk now about in the future, we're doing this, where now this earnings per share is some earnings per share 5 years from now, you end up with an expression for a future price earnings multiple that is shown here, where you assume a growth rate that applies 5 years from now, and reinvestment rate that applies 5 years from now, and a cost of equity that applies 5 years now. Now, the growth term is actually the reinvestment rate times the expected return on projects during this time. And if you assume mean reversion of that return to the cost of equity, the cost of equity factors out and you end up with this expression in the denominator. Now you've got 1 minus reinvestment rate in the denominator as well as the numerator. Those cancel out and you end up with a very simple expression for this period where you're assuming the return on projects is equal to the cost of equity. So typical cost of equity is 7%. So if we plug that into the equation, we can see here that we end up with a future PE that's right around 15. Now, typical cost of equities range from anywhere from 5% to 10%, resulting in PEs that can range from 10 to 20. So 10 to 20 with 15 PE being kind of considered kind of the middle or the typical PE. Now, Burton Malkiel, soon after recommending that a terminal value be determined through the use of this type of geometric progression that can be also used to calculate future PE, soon realized that the factors that go into this formula, namely the growth, the reinvestment rate, cost of equity, all are terms that are hard to forecast, and therefore you can end up with quite a range for your calculated price per earnings multiple. It prompted him to make the following comment in a book that he wrote called The Random Walk Down Wall Street, a book that he first published back in the 1970s, and the book is now in its 11th edition, and it's sold over 1.5 million copies over 40 years. But he made a comment, there is an inherent indeterminateness in valuation. That God Almighty does not know the proper price-earnings ratio or multiple for a common stock. Now, this comment has been taken out of context because what he was really referring to is that if you were naive enough to think that you could just plug in values today and calculate what the price today should be, that you're going to be disappointed because the terms are just that go into the formula are just too hard to forecast out. But if you use the formula to forecast a future price earnings multiple, where you assume something is going on, namely that the cost of equity or the return on projects mean reverts to the cost of equity, then you end up with a formula that's easy to calculate. And the only real issue with it is how far out in time do you go where you assume this condition of mean reversion. Now, over the years, the suggestions around how far you go into the future to calculate your terminal value varies anywhere from 5 to 10 years. Most people look for at least a length of time that covers a business cycle. But the reality is that once you go beyond 5 years, those 6, 7, 8, 9 year projections of cash flows get to be pretty wishful thinking. And just so uncertain, it's just best you just don't go that far out. So Polaris goes out 5 years is when it assumes mean reversion. And then based on the cost of equity, comes up with a specific value for the company that it's valuing. Well, now that we've covered the background behind calculating a future price earnings multiple, let's discuss sustained abnormality, where the return earned on projects reverts to something different than the cost of equity. And we're going to assume it reverts to a multiple of the cost of equity. So maybe, for example, 25% above, so we would multiply the cost of equity times 1.25, or maybe we assume it reverts to 75% or 0.75 times the cost of equity. But it reverts to something different than the cost of equity, just in a way that it's easier to work with mathematically. The main point is it does not revert to the mean, because that would imply a multiple of 1, and we're going to assume some other multiple of the cost of equity that it reverts to. Now, I want to stress that the valuation formula used by Polaris is built primarily around the fact that we have a future PE that mean reverts. That's the whole reason for moving forward in time, using what Burton Malkiel came up with, but moving forward in time where we can have a defensible reason for a very simple value for a price earnings multiple. So by not having a mean reversion to the cost of equity, we have made quite a divergence from the typical calculation that is done by default by the Polaris investing site. Now, when would it be appropriate to consider not having eventual projects mean reverting to the cost of equity? Well, this is typically for companies that are successful transitioning to new opportunities while maintaining, to some extent, their existing businesses. It's a company that referred to sometimes as serial reinvention. They've been able to demonstrate that they can repeatedly move on to the next thing without a major lapse in performance. This is also sometimes referred to as perpetual pivoting, meaning pivoting to a new opportunity. And then another concept that's often heard about with these kind of companies is the idea of increasing returns. We've all heard of diminishing returns, but increasing returns says that a company can leverage their previous investments in such a way that they don't butt up against a saturation of their markets, but they're able to exploit what they've done into continually into new markets. A company that demonstrates this well is Microsoft, and we'll be covering that by using the Polaris website as we wrap up this video. Well, stated earlier, the big difference as you move forward to sustained abnormality is the assumption that the return on projects doesn't mean revert to cost of equity, but some multiple of the cost of equity, and that's being represented by K. Then we'll go forward with that being some multiple of the cost of equity. Well, when you assume K is not 1, we don't have the convenience of the growth in the calculation of the PE ratio such that the reinvestment rate falls out of the formula and end up with a simple expression for the future PE. We don't have that anymore, because what we see down here is we still have to have a reinvestment rate, and then the formula turns out to be a little bit more involved as that reinvestment rate stays in the equation, both in the growth term itself in the denominator, and then also stays in the numerator. So the question is, well, what's a reasonable reinvestment rate to use? Well, Bill Nygren from Oakmark Funds commented several years ago, analysis gets real fuzzy when it comes to how much capital, or we're talking about reinvestment, will be needed to support growth. So it's a very challenging area to think through, and to carry that even further, to try to end up with a general expression for reinvestment is even that much more difficult. We'll come up with a defensible reinvestment rate. It's important to consider, we're assuming companies come from, and this is a H model that's been discussed in other videos, but this is a quick refresher. What we're assuming with the Polaris valuation model and with the calculation of the PE, future PE, is that we've had some period of time where we've had abnormal growth in the near term, and then we assume that things will eventually mean revert in terms of returns on projects, and then we end up with some growth rate of earnings forevermore in the terminal value period. Now, in reality, things just don't drop off 5 years and just go from an abnormal return on projects to some other mean reverted or other growth rate. And we talked about with the H model that really, you have more of an easier way to think of it mathematically is just a nice linear drop from a high rate of return that's being earned early in the first near-term cash flow period down to subsequently the terminal value period. So with these serial reinventing type companies, we're going to assume that the projects just from the near term just don't end when you go into the terminal value period. That these terminal or these serial reinventor type companies actually sustain their existing projects as they ramp up new projects. So in order to sustain their existing projects, it's going to be assumed that a minimal investment is made in terms of what's depreciated. So typically reinvestment, you have to consider total earnings and assume the amount that's reinvested to sustain existing projects is exactly equal to the amount that's depreciated. To seize new opportunities, assume that new investment is required, but mature companies will typically incrementally invest. Again, as they maintain existing projects, they will incrementally invest into new projects. It's not an all-in when shifting to the next big thing, but it's more done in a prudent way where you maintain the past and move into the future. Mature companies that are successful in doing this kind of perpetual pivoting tend to reinvest around a third of their earnings towards organic growth, or what's called new growth. That means that the remaining 2/3 of earnings is paid out as dividends and possibly stock repurchase. Now remember, we're talking about maintaining existing projects. That's done with depreciation, and that's already factored into the reported earnings. So what's left out of all that is what we're talking about being now a third of it used for new projects, a third of it dividends, and a third of it for stock repurchases. So 33% is a defensible amount to use in general for companies that we're talking about here that would mean revert to something besides their cost of equity. Now I want to stress that this 33% reinvestment that we're talking about is during the terminal period. So we are talking about a future state of a company. The remaining 66% is assumed to be distributed to the stockholders. Now most people think of distribution as dividends or stock repurchase, but it also includes the parking of funds outside of normal operations, typically in the form of a short-term marketable security like a money market fund, which I'm going to refer to as just cash going forward. So just to make sure we're clear on what's being discussed here, is that here's a quick view of an income statement, and as you get down here where the operating income is reported, the next thing is you take out any debt payments are made. But this S is what I'm referring to, is this accumulated short-term investments in operation in things outside normal operations. There's some rate of return that's earned, and that's actually considered interest received And so it's added to as you eventually calculate your net income. But the main thing is we're talking about this S here, that tends to, as companies park funds, that S gets larger and larger year over year, particularly for mature companies. Even companies that are not known for paying dividends or buying back stock do park funds outside of normal operations periodically in cash. And every year that's done, that cash flow is considered to be owned by stockholders. It's clearly evident when you look at the bottom left-hand corner. This is an explicit cash flow that most analysts do, and it's been covered in other videos. But I just want to focus on the bottom part here, where we look at the present value, or what's called the enterprise value of what's called free cash flows, but it's at the point of the firm or at the operating income. And as we move from this enterprise value, which is the amount, it represents the amount that an outside entity would have to come up with in order to buy the company outright. But if you take that enterprise value, subtract off the debt, and then add back the cash. So here's the important line: is you add back the cash, then you end up with the value to the equity holder. So it clearly shows that the cash and short-term marketable securities are considered to be owned by equity holders. And if it ever came to the point where the company was purchased and existing stockholders were bought out, they would receive value for the cash that's currently on the books. As companies, though, accumulate cash, they become under increasing pressure to either return the money to stockholders or invest it back into operations, which includes making acquisitions. In fact, Warren Buffett is often quoted about being on elephant hunts looking for his next big acquisition, because he usually has accumulated quite a bit of cash, and he realizes that he needs to put that cash to work or return it to the stockholders. Now, the reason the pressure mounts to do something with the cash is because cash lowers the average return on all projects across a company, because as shown on that income statement, you're only earning a minimal interest rate on these money market type funds compared to what could be earned on projects. Examples of companies with large cash balances currently are Amazon with over $40 billion, Berkshire Hathaway over $120 billion. Also included are Apple and Microsoft, each with well over $100 billion in cash. But now Amazon and Berkshire Hathaway are interesting because they neither pay dividends and do very, if any, stock buyback. Apple and Microsoft do now pay dividends and buy back shares, but there was a time in their history that neither one paid dividends or bought back a lot of shares. These examples demonstrate that as successful companies mature, they find it increasingly difficult to find worthy projects to invest in a timely fashion. So either they pay back dividends, buy back shares, or accumulate cash through investments outside of normal operations. So as companies saturate their current markets and transition to new markets, they tend to gravitate to a reinvestment rate of around 33%. This occurs even for companies that do not pay dividends or buy back stock. All right, so now that we have a reinvestment rate that we're going to apply in general, we end up with this expression for the growth, which is in the denominator. It also shows up here in the numerator for the future PE calculation. And here's the reinvestment right here. Now the question comes up, well, what happens as you vary the K? What are you reverting to? How much of the cost of equity are we reverting to? Well, to see the impact of that, we've got a spreadsheet that goes through that. And let's assume that we use a normal cost of equity of 7% with a reinvestment rate of 33%. And now we use different K factors to see what the overall change in the PE is. So this is, let's take an example that if we keep it at 1, then the change to the PE is, there is no change. You just multiply the PE by 1, and that's the resulting PE. But let's say that we use a K factor of 1.25. Well, we can see here that that ups the future PE to 16.8, which compared to 15.3 is about a factor of 1.1 larger. So as we look through this, we notice that here in the green area in particular, that we're not going to see much change at all as we change these two different values that go into the growth calculation and therefore into the eventual calculation of the future PE. So let's do that right now. First of all, let's vary the cost of equity and ask you to pay attention to these values here. So as I change this, let's take it up to 10%. These terms in here really didn't change that much, and really even across all the different K factors, it didn't change all that much. If I take it down to, like let's say 4%, same thing, it really doesn't change the overall change to the PE that much. So that allows us to now just focus on, well, what's the changes we alter our assumption about reinvestment rate. We are going to use 33%, but let's say we just want to just see what the upward change would be if we upped it to 40%. Well, it does change in the with some of the extreme values, but again, this kind of normal range of K values, it doesn't change all that much. And if we take it down to like 0.25, again, it does, we do see on the extremes changes, but here down the more normal ranges of K, it doesn't change all that much. So where that leaves us is with some values for K that are more normal, normally like a 1.25 and a 1.50, resulting in these kind of multipliers of the PE. And then at the other extreme, some really low, typically you're only getting, if you have a company like Sears, GE, or Ford, maybe you're going to assume a lower reversion to something lower than the cost of equity, at most maybe 75%, and it results in that kind of a multiplier there. But for companies like Amazon, Tesla, Microsoft, you're typically in this range. Maybe in a rare situation, you might want to think through reverting to a cost of equity that's 1.75 larger than the cost of equity, and that would end up in a PE multiplier of 1.50. Now the relationship between the PE multiplier and the K factor can be expressed as a formula, and that's shown here, where M is the PE multiplier, is also equivalent to 1 plus, I'll call it lowercase m, because when you take a price divided by an investment, typically the price is larger than the investment, and you get 1 point something. So the overall multiplier, PE multiplier, is the 1 point something. But you can also express it as 1 plus, I'll call it lowercase m. So let's take an example. If you had a multiplier of 1.5, m, the multiplier is 1.5, but this lowercase m is just 0.5. And it can be shown to be equal to this. Well, solving that for K, which is what we talked about over here as being the K factor, you get K equal to 1 plus lowercase k. So again, the K could be like 1.25, and then lowercase k is 0.25. Anyway, it can be shown to be equal to this. Now, if you assume that the reinvestment rate is 0.33, which we did discuss over here as being typical for a mature company, then you plug that into the formula, and you can see that M from this formula up here becomes just simply K divided by 2 minus K. And then when you solve this formula for K, you get K equal 2M divided by 1 plus M. So let's take an example. You have a multiplier of 1.5. In that case, the M is 0.5. Then you plug that into this formula, and you get 1 divided by 1.5, which is 0.667. Now just for a quick check, if you plug in 0.667 into this formula, you get 2/3 in the numerator and 4/3 in the denominator. And you end up with the multiplier being 0.5. So let's discuss the derivation of this PE multiplier M formula here. If you look at the bottom here, we've got price per book value, a fairly well-known formula for that, where it's return of equity minus earnings growth divided by the cost of equity minus earnings growth. And if you move to the left here, it shows the derivation of it. It's based on a well-known perpetuity valuation formula where constant earnings growth is assumed and expected return on projects is ROE. And then just using this observation over here about growth, you can see where the well-known formula comes from. Let's back up and discuss this perpetuity valuation formula. It is shown here where price is equal to, and sometimes that's referred to as valuation, but here we're referring to it as price, but it equals next year's earnings times 1 minus the reinvestment rate divided by the cost of equity minus the growth of earnings. Now note, if you divide both sides of this equation by next year's earnings, that's the price per earnings, or sometimes referred as to the PE next 12 months, forward-looking, as opposed to trailing 12 months. And that is over here is shown as the PE equals 1 minus the reinvestment rate divided by cost of equity minus the growth of earnings. Now another way to express next year's earnings is you can take a return on investment. So if you multiply both sides of this equation by investment, you get return times investment equals earnings per share. So if we were to substitute that in over here, we get R2 times investment. But what we're going to do is we're going to divide both sides by investment. So we just end up with a rate of return times 1 minus the reinvestment rate divided by the cost of equity minus the growth of earnings. Now, returning back to the price per book value, what you do is you set R2 equal to the return on equity, and then you end up with this well-known formula where the growth of earnings is also assumed to be return on equity times the reinvestment rate. Now back up here, instead of assuming R2 is return on equity, we're going to assume that R2 is equal to the cost of equity. But growth, which is return times reinvestment rate, we're going to assume that that return is a factor of cost of equity, not just cost of equity. Well, another way to look at that is you can go back to this original formula, perpetuity valuation formula, and express price here in the numerator of this expression. And then in the denominator, you express a price when return on projects equals the cost of equity. You get this well-known perpetuity of just earnings divided by the cost of equity. Well, you do the math here, you can write back up with this earlier expression of cost of equity times 1 minus reinvestment rate divided by cost of equity minus the growth of earnings. But again, we're in this formula up here, we're going to assume the growth is a factor of the cost of equity times the reinvestment rate, and not just the cost of equity times reinvestment rate. Well, anyway, we get us to this point where we have this formula here. Now, if we assume this growth here incorporates a return that's a factor of cost of equity, namely K, which is what we used way back in this earlier discussion of P multiples and K factors. But we also can think of it as 1 plus K, and we've been through the difference between capital K and 1 plus K. But let's go with 1 plus lowercase k. And what you can do then is plug it into this formula, and you'll see that cost of equity can be pulled out of the denominator, and then it divides out with the cost of equity in the numerator, and you're left with this expression here for the PE multiple equaling this expression here. Now this is clearly seen if you back up here to the original definition of PE, and if you assume this growth rate is a factor of the cost of equity factors out of the denominator, then when we include it in this expression here, the cost of equities cancel out, and then you just end with this simple expression for the PE multiple. Now I want to make sure it's understood that this PE multiple formula only applies to a PE multiple that was calculated at equilibrium, because in its derivation we assume the denominator is an investment where the return is the cost of equity, and therefore we end up with a equilibrium price for investments. So the multiple itself, the formula, assumes you're starting off with an investment priced at equilibrium. So, for example, if you have cost of equity of 7%, its equilibrium PE is 15.28. So if you wanted to know, well, if I wanted to do a what if it was 18, then you could figure out the multiple here and then use the formula to determine the implied factor that you're multiplying the rate of return by. But it only works if you're starting from a PE that's based on an equilibrium price. You can't just take an arbitrary PE 27 and say, well, what happens if I move it up to 30? What would be the implied R? No, because again of this denominator that's being used in the derivation of the formula, it has to be an equilibrium-based PE. In the Polaris website, that is what's shown by default. So you can use this formula with those PEs. And then, like we stated earlier, if you let the reinvestment rate equal to 0.33, you end up with these simple expressions for the lowercase m of the price multiple of this k divided by 2 minus k, and then you also can determine that lowercase k equals 2m divided by 1 plus m. Let's pull this all together and go through another example. Let's say you have currently a valuation that's based on an equilibrium PE of 10, and you want to know what the implied rate of return would be if you up the PE from 10 to 15. Well, that would be a PE multiple of 1.5, or as we did in the earlier example, that would be a lowercase m of 0.5. So when you calculate what the resulting R value would be, you realize that you're dealing, you do the math and you get this lowercase k equals 0.667, which is a k factor of 1.667. So if we assume that the cost of equity was 0.07, and now you just take 0.07 times the factor of 1.667, and you get a implied rate of return of 11.7. Now this is a side note. We calculated a k factor of 1.667, assuming a PE multiple of 1.5. If we compare to what we talked about earlier, we're just approximating. We had a 1.5 resulted in a k factor of 1.75 versus 1.66. But what we were doing earlier was an approximation, and now with this we have an exact formula. As a quick reminder, if you wanted to work the other way, instead of having a PE multiplier and then figure out what the implied return value is, you may want to go with a certain return value and understand what and figure out what the resulting PE multiplier would be. And if you wanted to do that, you just use this formula here for M. Now, if you want to back up even further and use a different reinvestment rate, you would need to go back to these formulas here, figure out what the K values and M values would be. But it's highly advisable that you keep the reinvestment rate to 0.33 and just use these two formulas here for understanding what a implied return is based on a PE multiple, or what the PE multiple would be if you assumed a certain rate of return. So after you've slid the PE multiple value and determined the resulting multiplier, plug that into this equation here that is assuming a 33% reinvestment rate. Calculated a K value, plugged it in, and ended up with a rate of return that's being implied by that change in PE multiple. You want to do a sanity check against that computed return value. And the sanity checks that you typically want to do is you want to compare it to the accounting return on equity. It's called the implied historical return, expected future return, and then some general guidelines. So next we're going to go through each one of those sanity checks. First sanity check is just to compare your computed future R to the accounting return on equity. But keep in mind that the return on equity can be distorted by accrual accounting, particularly if a company has a history of doing stock repurchases primarily for employee stock options, and if they're out there buying the stock above book value, which is typically the case, that the way the accounting works ends up decreasing equity. So more stock repurchasing being done, the more equity or book value, which is the denominator of return on equity, gets distorted, and therefore this number can be a little misleading as a sanity check. Next sanity check is called the implied historical return, and it's dependent on the calculation of reinvestment. So let's talk about where or how that calculation is done. First off, distribution, sometimes referred to as free cash flow to the equity holder. If you want to take this kind of internal view of what's going on in the company, you take net income. You have to calculate the change in depreciation from one year to the next, the change in capital expenditure, change in working capital, net debt. It's pretty involved, easy to make mistakes along the way, and therefore the number you end up with, called the distribution, can be pretty far off. So instead of doing an internal view, it's advised that you do an external view, which says you just look at the dividends and the net stock repurchases that the company has done. Now, luckily, that's straightforward to do with the Polaris site. And here, if you go down, like for Microsoft, here in the company information section, dividend yield, you just take this percentage times the current price, and it gives you the dividend. And then here's the average payout. And then it also shows the share issuance, the percentage here. The payback can be calculated by just taking the share trend times the current price divided by current earnings per share. Now, if you're using the Polaris site, the way you get the earnings per share is you take that dividend yield times the current price, you get what the dividend is, and then you can use the average payout shown here, which is dividend divided by earnings per share, to calculate what earnings per share is. And then you can calculate this net stock repurchase amount. So you end up with a payout rate and a buyback rate, and therefore your distribution rate. Now, 1 minus that is your reinvestment rate. And then once you have that, you calculate based on the earnings growth, historical earnings growth, which is fairly easy to obtain. You can go to this average payout link, let's say here for Microsoft, and scroll down, and Reuters site, you can get growth rates like here of 12.5% for Microsoft over the last 5 years. So assuming that is a historical growth rate, you can then come back and calculate divided by the reinvestment rate that you calculate, and you can get it R. Now, it is heavily dependent on this calculation of reinvestment. It's easy to get that wrong and then end up with an R value that's not an appropriate value to compare against. So you got to be careful with the reinvestment. Those interested in knowing more about the calculation of the reinvestment rate, suggest you watch the cash flows video in the concepts playlist out on the Polaris investing website. Well, now that you have reinvestment rate calculated, it's a good idea to check the project return implied by the sales growth slider. To do that, you use this formula here to determine the growth of earnings based on the value of the sales growth slider. This formula is also shown in the average ROE tooltip in the company information section on the Polaris website. Once you have calculated growth of earnings, divide it by the reinvestment rate to see if it results in a reasonable return on projects. These first two approaches we discussed, namely return on equity and now this implied historical return, have dubious ability to really tell you much about whether your computed rate of return based on moving the PE multiplier is really reasonable or not. It's just there's a lot of potential problems with both ROE and determining the reinvestment rate, therefore making the R in the second approach questionable as well. These last two sanity checks, namely the expected future R and then just using some general guidelines, are probably the most reasonable way to really do sanity checks against this computed R value based on changing the future PE multiple. So let's talk more about the expected future R first here. And it simply is just taking a ratio called the sales to capital ratio times the future profit margin to compute or implied rate of return. Now, you can usually see that sales to capital is literally just sales divided by equity, and then the future profit margin is net income divided by sales. So you do the math and you get net income per equity. You might say, well, that's the same thing as return on equity. Well, it is, but the big difference is we've broken up the return on equity into two different ratios, and now we're forecasting going forward what's the likely sales to capital ratio going to be, what's the likely future profit margin can be. So the suggestion here is to look at a range of possible ratios. Now on the Polaris side, you're given the default future profit margin. So really you're looking at a range to think through in terms of sales to capital. You can go to the Polaris website, and at the bottom here you get what the historical sales to equity has been. In this case for Microsoft it's 1.4, and then you can kind of say, well, that too was based on equity, which has problems just like mentioned up here for the return on equity. So you want to kind of think through, well, what if sales to capital wasn't 1.4? What if it was maybe 0.9? What if it was 1.9? And then you multiply it by your future profit margin, you get a range of R. But what you're doing is you're comparing that range of R to the implied R that's being that you're going with when you change the PE multiple. And as long as that R is below the range of R's that you calculated using the sales to capital ratio, then you probably have a reasonable PE multiple. Now you want to think through some general guidelines. And first off, I want to start off with in this second stage, we're going to assume a 33% reinvestment rate that we've discussed earlier. And by the way, I did bring in a note down here that this talks where Bill Nygren from Oakmark Funds, very well-known private equity fund manager, said the analysis gets real fuzzy when it comes down to how much capital will be needed to support growth. But as we mentioned earlier, we're going to go with a 33% reinvestment rate where most mature companies tend towards. So this check is taking the R that you just calculated up here, and or with your PE multiple, and now multiply it by 0.33 and compare it to the current 10-year T-bond rate, which is a proxy for the risk-free rate, which that is also approximation for the growth of economy. So if you end up with, let's say, an R of 15% and you multiply it by 0.33, you get 5% growth. But if you go out and look at the 10-year T-bond and it's currently set at, let's say, 2%, then you got to question whether a company can really maintain growth of 5% forevermore when the growth of the economy is around 2%. Another thing to think through is that this observation that it's rare for mature companies to continue to have a rate of return on projects that's significantly greater than their expected cost of equity. So you typically want to keep it, below the cost of equity plus about 0.03. So again, if you have an R of 15 that you've 15% that you've calculated, but the cost of equity is 8%, that means you're 7% above what would typically be expected. You need to consider if that's reasonable. All right, just to help further our understanding of what we're discussing here with these K factors is let's look at in fact, we've seen this kind of a graph before. In fact, it was shown at the very beginning of the presentation when we showed this PolarisInvesting.com site. In this graph here, we show a linear representation of future valuation and then price that varies around that. So we're showing that yet again here. But just to show what the impact is of these different K values, since the second term of the valuation formula, the terminal value, where the future PE plugs into, makes up 80+% of the total valuation, we end up with a change to that K factor that, for assuming that it's greater than 1, meaning that future projects returns mean revert to something greater than the cost of equity, then we're going to see a shifting up of the valuation line. If K is less than 1, then we're going to see a shifting down of the valuation line. But it's also going to change our thinking about how we think the market's going to likely, market prices are going to fluctuate around that valuation line. So as we move it up, we also assume that market prices, or the market is aware of the assumptions that we're rolling into the increased K value, and therefore their expectations about price are also changing. So the whole thing either shifts up or shifts down. When thinking through K values, it is important to consider many qualitative factors that create enduring value. Some of these factors are briefly discussed in the valuation calculation future PE multiple video around the 29-minute and 30-second mark. Enduring value is often referred to as a moat or barrier to entry or sustainable goodwill. It consists of two major types of assets, tangible and intangible. Unlike in the past, today most of the enduring value comes from intangible assets. Tangible assets consist of hard assets like property, plant, and equipment that are reflected in operating leverage and financial leverage. Intangible assets consist mainly of things ranging from the company's business environment to key customers and suppliers. I suggest you pause the video and review the list of intangible assets. Companies with enduring value are often referred to as consumer monopolies. Consumer monopolies have the following characteristics. They have an R much greater than their cost of equity, requiring little reinvestment. They have little R&D and products that don't become obsolete quickly. Debt is a choice. Little debt or debt that can be drawn down quickly. Earnings increase in a predictable manner, little volatility. And they have in-demand products that are habitually purchased and used up quickly, requiring frequent repurchase. All right, let's end the video here on a concrete example. Going to be using Microsoft. You can see here that current price of Microsoft is $118, but the theoretical valuation that's being calculated is quite a bit lower, at right around $75 a share. We look at the sales growth that's been defaulted to, or that's been calculated by Polaris of 18%. That seems pretty aggressive, so not thinking that the change or the difference between theoretical and the price has anything to do with the sales growth that's being assumed. Now we do look at here in the implied sales growth is 30%, but as we've talked in other videos, that's just a reverse calculation of the formula, not varying anything else, and then it comes up with a 30% So we could just move this to 30%, but I think there's probably other factors weighing in where something else besides sales growth. So if we scroll to the bottom and look at other input values used in the valuation formula, we see a profit margin that currently is 22.2%, and that's the same profit margin that's being used going forward. And that seems reasonable for a very mature company like Microsoft. Even as they enter new markets, they're probably only seeking out markets that can help them maintain their profit margins. Future shares, see that the issue trend is they're doing some stock buybacks, but nothing really flags as anything that needs to be changed there in terms of what we're using currently in the formula. But as we look at the future PE, we notice that the current PE is almost 26, but the future PE that's being used is only 13.2. Now, as discussed in other videos, the way you quickly determine the cost of equity that's being assumed is you take 1 divided by 1 less than the current PE, so that's 12.2. So 1 divided by 12.2 means it's using about an 8% cost of equity into that terminal value period. Well, as we said, Microsoft has demonstrated that it is one of those perpetual pivoting kind of companies, or a serial reinventor. So it would make sense to consider a K value that may be in the order is even as high as 1.75, which very few, maybe a handful of companies that this would ever be something you'd even want to consider. But that would result in a multiplier of 1.5. Well, if we go back and look at what would be the impact of multiplying by 1.5. First of all, the factor of 1.75 means that we are assuming that it will revert to a number 75% greater than the cost of equity of 8%. This means we are assuming a return on projects in the terminal value period of 14%. It also means that the valuation increases by 50%. So as we've shown in other videos, you just move this up till you see a 50% increase, which is about 50 half of 75 is about 37. It's about up in the 112 range. So I'll leave it at 114, and you can see what it does to the practical investment return. We're still below the current price. Since originally recording this video, 2 other input sliders have been added for future profit margin and future price earnings multiple. These values used to have to be entered indirectly through the sales growth slider, but now can be entered directly through their own sliders. Again, the updated values from assuming projects in the terminal value period will mean revert to 14%. Finally, doing some quick sanity checks, notice that the return on equity is 23%, so that's quite a bit higher than the 14% we're assuming, but as mentioned earlier, return on equity's got some accrual accounting issues, and for Microsoft that's particularly true with all the stock options that they issue to their employees. So moving on to the next sanity check, which is the implied historical R. Doing some quick math here, we can figure out that the payout and the buyback ratio ends up in a reinvestment rate of around 50%. Taking the average payout link to the Reuters site, you can see that the average 5-year earnings growth for Microsoft is around 13%. Dividing that 13% by a reinvestment rate around 50% results in a return of 26%. So the 14% is quite a bit below that. Using the sales growth slider of 18%, you can calculate that equates to, with profit margins not changing and moderate share repurchases or buybacks, is about 18% earnings growth, and then divide that by 50% reinvestment, and that's 36% return. Based on this approach, we have a 26% historical return, and then over the next 5 years, forecasting a 36% return. But as mentioned earlier, this approach is heavily dependent on the calculated reinvestment rate. So let's move on to the next approach, and that is using the sales to capital ratio and future profit margin to calculate expected future R. Well, sales to capital ratio is 1.4 and the future profit margin is around 20%. So that results in a 28% return. Now, if we consider a range of sales to capital and drop that ratio all the way down to 0.8, it still results in an R of 16% or above when we multiply a profit margin of around 20%. Final sanity check is just general guidelines, and assuming a reinvestment rate of 33% with an R of 14%, that results in a growth of 4.5%. Compare that to the risk-free rate as a proxy for the growth of the economy, which is around 2%. 4.5% growth seems pretty extreme. Second general guideline is to look at the return 14% compared to the cost of equity, which is 8%. So that's 6% higher. And typically, the guideline says no higher than 3 percentage points. So we look for at most an R of 11%. So considering all the sanity checks, it seems like 14% is reasonable. May want to back it up, maybe 12 or 13%. All right, this has been a video on sustained abnormality. This is one last reminder that it's assuming that terminal value period returns will revert to something else besides the cost of equity should be done for very few companies. We did an example of Microsoft as being one of these serial reinventors or perpetual pivoters that have demonstrated they can do it successfully, but it should be something that is only considered for very few companies. Thanks for watching.